So, hi everyone. Happy Wednesday. Welcome to, and Happy New Year. Welcome to our Multifamily Freedom Chasers financing Zoom call. Today is our first financing Zoom call back for the year. My name is Shelly Miles, for those of you who do not know me. I'm an author, a commercial mortgage broker, and a co-founder of our brokerage company, Adventure Commercial Capital, together with Mr. Jerry Miles, who will introduce himself in just a few. So what our company does at Adventure Commercial Capital is connect real estate investors like yourself to lenders, investors that would like to buy multifamily fix and flips, storage units, hotels, businesses that has real estate attached to it, because each investor is unique and each deal is unique, and we have the skills to connect you to the right lender. Now, if you're new here, let me open up my chat. Hang on one second. If you're new and it's your first time, please put a 10 in the chat. We want to welcome you, and we hope we can add some value to you and your real estate journey. Also, I want to remind you guys to use the chat to connect with each other. So throw your info in the chat and connect with each other. Tell where you're from, give your market, and your contact info. Our Zoom calls will be a little bit different this year. We will explain that in just a few. You want to go to the next slide?
Yes.
So today's agenda, we are going to talk about our ecosystem a little bit, our community ecosystem. We're going to do an introduction. We're going to talk about the current debt market, and you have your main topic, which is different ways you can invest in real estate in 2025. And we have a Q&A section for Access Pass members only. You want to go to the next section? So here is our new setup that we're going to be doing with the MFC community. We have Trevor, which we usually have on Monday nights. He's only going to be doing that on the first Monday of the month. It's not going to be every Monday or every other Monday like it was last year. And then you can get activated with him for the week with a celebrity guest, celebrity speaker. You can get educated. You'll get value and building your community together with Trevor and his celebrity guest that he has on there. Then you have asset management with BB and Iffy. If you close a deal, what do you do next? The real work really begins at that point. You will learn the fundamentals and explore real life scenarios, challenges, and solution for your multifamily operation. Then you have us, and they are the second Monday of the month. So the second Monday of the month. So we're going to do our 4 Zoom calls we have with Trevor, BB and Iffy, myself and Jerry, and Ed and Kevin. If you guys know all these Zoom calls, we're going to do it once a month. And we're going to take the first 2 Mondays is Trevor, the second Monday is BB and Iffy, the third Wednesday is Jerry and I, and then the fourth Wednesday is Ed and Kevin. And with Jerry and I, you'll get live updates with the current debt market, and you will learn how to take down and find and qualify for the big multifamily deals. With Ed and Kevin, you will learn how to engage with brokers, source deals, and underwrite quickly and efficiently with Ed and Kevin. But yeah, this is how we're going to be from now on. We're all going to take 1 week of the month. We're just going to do 4 weeks of the month, and we're going to rotate from there. So if you want to connect to, if you're new, let me see, I didn't look at my chat. Oh, we have some new people in the chat. Hi, Mark. Thank you for being here. Are you letting people in, dear?
I am.
Okay. Let me throw the MFC, if you're not part of the Multifamily Freedom Chasers Facebook page, Facebook community, let me throw that in the chat so you can have it. I am normally prepared for this, and we haven't been on these calls in like a month, and I'm like not prepared. But here we go. Here's the link to the Facebook community. Just connect with us through that, and you'll be able to get all of the event updates and when it's happening through the Facebook if you're on Facebook. If not, we do send out an email, so your email is captured here under our Zoom call right now, and we'll have your email through that. You can also connect to us on YouTube. You can get all the calls in the past that we've done on YouTube, Spotify. You can connect with us on Facebook, Instagram, and we also have a WhatsApp community chat as well. It's on the next page if you want to scan this QR code, Jerry.
Yep.
If you scan that QR code, you'll be part of the WhatsApp community and you can connect with people in there as well that are like-minded. All right, I think I'm done talking for the night, Jerry.
Alrighty. All right. Hello, everybody. I am Jerry Miles. This is a picture of me and Shelly with our boys. We are commercial mortgage brokers and the founders of Adventure Commercial Capital. We lend on commercial and investment real estate nationwide. Um, that's why we do these educational Zooms, so we can connect with more investors. And we also think it's important to be a part of the real estate investing community. We've been real estate investors ourselves for over 10 years now, and work full time in real estate investing, lending, uh, and also in a construction company that where we service a lot of multifamily owners and things. So that's us. This is our contact info. If you would like to connect with us, that's my cell phone number. That's our email. Um, and then that QR code will give you access to my Hi Hello card. We'll keep that up for just a minute. If you have deals you're looking at, need help with anything on that front, that's a good way to contact us right there through email or phone call. So I do have people that send me messages on WhatsApp or Facebook, or not, well, yeah, sometimes WhatsApp, Facebook, or Instagram, and I just don't check those as often. So my cell phone or email is the best for me. So we'll start out with the current debt market update. Um, towards the end of the year last year, the last quarter of the year, we started having rate cuts. We had about 75 basis points in rate cut. Um, and rates have actually gone up since then. The actual final rates that we pay on deals. The federal funds rate's gone from 5 to 5.5 to now 4.5 to 4.75. But the mortgage rates that we pay, when we're paying our mortgage or we're taking out a new loan, have gone up, and they've gone up quite a bit just in the last 30 days. I'm not sure what the date was when we had our last Zoom. I think it was like the 16th of December or maybe the 13th of December. But the 10-year Treasury was at 4.2. Today it's at 4.6. The 5-year was at 4.12, and now today it's 4.43. So that's what, almost 40 basis points on the 10-year has gone up, or 35 basis points, and then um, we're 30 basis points on the 5-year. These treasury rates determine the rates we pay when we're looking at long-term debt. Whether it's a DSCR loan, a CMBS, Freddie and Fannie, what they do is they take that 10-year Treasury, and then there's a spread added on top of there, from the bank or the lender, and that's the lender's cut or the bank's cut, that spread on there. So things have not gone down. I know that they've tried to push them down a little bit, but it just hasn't happened. So what will it take to get the treasuries down? I just don't know. Um, when I listen and try to understand all the economists and the experts on what they're explaining, a few weeks will go by, and what they explained is going to happen doesn't happen, and it just goes the opposite direction from what everybody's saying. So we'll just keep watching, and hopefully they come down at some point here in the near future. If not, we'll keep doing business because that it is what it is. So we've had a stagnant market over, I guess, the last 3 years, and it's starting to break free. And I think people are just starting to come to the realization that rates are where they're at. Um, you know, we're not, guaranteed that things are going to come down. When things started going up, everybody thought, well, it's going to come back down. It's going to come back down. Things will get better. Things will get better. And now 3 years into it, and I think everybody's starting to realize we might be up here for a while. So yeah, people are losing faith in the rates coming down, and there's just a lot more deals coming to the market. Major correction is underway with $2.7 trillion of debt maturing by 27. A half a trillion in 2025. There was a half trillion in 24. Um, but we just haven't had a lot of transactions happening, even with all the debt maturing. And a big reason why that's happened is banks are working with the borrowers right now, and they're giving them extensions. Here, pay a point or pay 2 points, and we'll extend the debt out. You know, work on getting your NOI up. Maybe rates will come down a little bit, be more favorable for a refi. And that's kind of what's happening right now. If the rates continue to stay up, the banks are not going to continue working with people. They're going to make force sales. They're going to be, things will get ugly if the rates stay high. If rents don't come up to match to where NOI can come up to. So, and like I said, these numbers might be actually higher, just because you know all of the deals over the last 2 years that have been extended are going to be added to those numbers. So this is a shot at what the Freddie Mac small balance loans look like. This is multifamily, stabilized properties, 90% or better. Um, and this is the small balance. So with Freddie Mac, that is 2 million to 6 million. Okay, or 2 million to 7.5 million. Fannie Mae is the next page, and that is 2 million to 6 million. After that 7.5 and after the 6, we go to what they call conventional rates, and the spread gets a little tighter. So where you see a 6.6, you might see a 6.1 or a 6.2. It just gets a little more favorable. So here's the Fannie Mae. Back when we did our call in December, where you see the rate ranges, a lot of them, would start out in the fives and go up to the mid sixes. I don't see on either of these sheets, we don't see any fives now. But we do on the Fannie side, we see some sevens. So just kind of shows where rates are heading on the multifamily side. DSCR rates have gone up. Just CMBS has gone up. That's based on the treasuries as well. So um, that's kind of where we're at right now. If you got a quote on something that you're shopping for, and let's say you got a quote 2 weeks ago or 3 weeks ago, that quote's probably not good anymore. You need to get a fresh quote. So different ways that you can invest in real estate. We're just going to kind of go through a bunch of different things here. And I'm not really, we have invested in mainly. I mean, we've had some duplexes, we've had single families, we've had condos, we've had, we haven't invested ourselves. We've lent on quite a few multifamilies, but we haven't invested ourselves in multifamilies, except for the duplexes. Um, but people make money on all different types of real estate. You'll hear different gurus that blast every different type of investing than what they do, but I mean, genuinely, all different types of real estate, there's money to be made, just like different markets. If there's apartment buildings in blue states and people are making money on them, it might be a good investment. If they're in red states, it could be a good investment. It's just a matter of what are you looking to do? What's your pain tolerance is, all these things. Um, so first we're going to talk about active investing, where you're actually doing the work, you're doing the legwork of picking them out, of shopping for them, of making offers, of buying, of putting money together, all these things. So that's what we're going to talk about first. And so we've got the single family 1 to 4s. These right here.
Can I ask a question?
Yeah.
Before you move on, somebody wants you to explain what CMBS is.
Commercial mortgage-backed securities. Um, on the CMBS loans, they'll lend on multifamily hotels, self-storage. It's a lot of commercial real estate, shopping centers, all these different things, and they'll take a big load of those loans all together in a package, and they'll sell them to Wall Street, and it becomes a security. People invest in it. Um, so that's where CMBS comes from. So, all right. So single family 1 to 4s, they're easy to get into. If you've got an extra 30, 40,000 laying around, you can generally get into one of these. In most markets, there are exceptions. Wholesaling, um, those people out there are killing it wholesaling. Um, hearing like the story of Donald Trump, his first real estate transaction was just a wholesale deal. He, found a property, talked to the seller, worked a deal out with it, and then found someone else and sold them on the project that he had planned in his head. And he walked away from the deal. He marked it up 900 grand and made 900,000 on his first real estate transaction. Um, and so, I mean, that was just a wholesale deal. We've bought from a lot of wholesalers, and they'll make 5 to 10 grand on a deal, selling single family houses. They just lock the deal up and find another buyer. Um, Flips, fixed to rent. Work can be intensive. Once again, if you've got 30% of a project, you can get into it. 20% of a project in some cases. We can lend on these 10% of the purchase. Then we'll fund the construction. Um, but that is up to 65% of the ARV. So, uh, short-term rentals, all these things can be very profitable, wealth building. One, thing, I mean, a lot of people when they're doing this, there's a lot of people that get 20 or 30 or 40 or 50 of properties, and then they kind of get stuck because it becomes very hard to scale on these types of properties because generally they're scattered around town, maybe in one neighborhood, maybe in a county or 2 counties or whatever it is. But it gets hard to scale when you're buying the smaller stuff, and a lot of people slow down as they get more and more because of that. You know, with real estate, it's always you got great tax benefits. You can do these alone or with a partner. If you don't have credit, you don't have cash, find someone that loves real estate investing or wants to make some extra money, that has money, maybe good credit and things, and you can put these deals together with them. Um, so funding of the smaller deals, when we're talking about that last slide, um, you will need skin in the game. Um, on a fix and flip, 10% minimum. when you're purchasing rentals that are stabilized, good condition and things. We can lend up to 80% on those. So you'll need 20% plus another 4 to 6% in closing costs. And then you'll need reserves. So it's safe to say you'll need 30%, just to get into one of those. Um, and a credit score of 660 or better, for the sponsor. So liquidity past closing and experience helps. But on these smaller ones, we have lenders that'll lend to people without experience. So population is something that you need to look at when you're looking at deals. If you're close to a big city, don't worry about it. But we look at a lot of deals that don't meet the population requirements. So, um, if there's no city around that we can really pull from that has the population, we can expand it to the county. And we need 169,000 people in a county to be able to lend in that county. So now our county we live in, I think we have 145,000 people in our county. So this county would generally not be populated enough, but we butt right up next to Hamilton County, which is Cincinnati. So there's enough of population there. We're 20 miles away from Cincinnati, so we can pull off that population. So, but if you're out and you're in an area where all the counties around you are kind of the same situation, um, we won't have enough population. And also most lenders don't like high crime. So going bigger, multifamily, 5 units plus. Um, I get a lot of deals sent to me where people are buying smaller multifamilies. It could be 40 units, could be 10, whatever it is. But when we're looking at deals that will have a loan amount that are sub 1.5 million, it gets really difficult to find funding for these deals. And those deals generally you're going to have a lot higher interest rate. So when we're looking at the Fannie and Freddie sheets that I showed before, where rates are in the mid sixes right now, um, rates are in the mid sixes for deals with 2 million in debt or above. So we're looking at a purchase price of 3 or 4, 3 to 3.5, 4 million at minimum to get that loan amount where it needs to be to qualify for the Freddie and Fannie debt. When we're looking at a private lender or someone like that that's going to lend on the smaller multifamilies, 5+ units, um, and loan amounts less than 1.5 million range. And I say 1.5 million because we can talk Freddie and Fannie into doing them at 1.5 million or better. They cut it off at 2 million, but if we have a good deal, we can get them to go down below the 2 million. But those deals get really hard to find funding for. And I will tell you the reason why, even like with the small balance Freddie and Fannie, the rates get better as the loan amounts get higher, because these smaller deals have a higher default rate. Um, when you're getting more than 4 units, so 5 units plus, and we're below that 1.5 million, that is like very, very high default rates in that range of apartment buildings. So keep that in mind when you're looking. Rates in those properties are going to be in the eights right now, generally on a stabilized property. Going to be in the eights, and you know, so if you're buying a property and your debt's going to be in the eights, you probably want to get it for a 9 cap or better. So that's just my word of advice there. So um, these are usually done with a few partners, or you'll syndicate these deals. Um, This is the case for all commercial real estate, not just multifamily. Shopping centers, hotels, um, self storage, all these projects. These what we're talking about here are kind of the same thing. So, um, how can you get involved in these deals if you're not involved right now? I will tell you, making relationships with brokers and being able to find the deals. Um, if you can find a good deal, uh, you can you won't have any trouble finding someone that will invest in a deal or someone that will KP the deal with you or partner with you on a deal. Another way to get involved, and this is always an issue on every deal that we have been a part of, is raising money for the deals. If you've got a network or you can go and talk to people and you can raise money for deals, you can get involved in just about any deal that anybody's doing because they always need people to raise money. They always need more money. That's just always the case. So, um, funding for going bigger, some of the requirements and things. Um, Deals need to cash flow on the deal itself here first. The deals need to cash flow, or you need to have a business plan to be able to cash flow in the near future. So when we're looking at maybe a property that needs some help, maybe it's been mismanaged or needs some rehab and things like that, needs to be leased up. You need to have a business plan to be able to do that in a timely manner. The lender wants to know that they're going to start getting paid back right away. So on a stabilized deal, they consider stabilized 90% or better. If you're in an area where the occupancy rate on average is below 90%, Freddie and Fannie will drop those requirements of the 90%. I think the occupancy rate in Houston, Texas is lower. It's like 87 and 89%, somewhere in there. So when you're in Houston, Freddie and Fannie will take that into account and they'll consider that a stabilized property in that area. So there's certain cases where these rules I'm throwing out don't always apply.
Yeah. Hey,
Uh,
there's a chat if you want to look at it.
okay.
There's two now. Or I don't know if that's a question. Okay. There's one from Mark. That was the first one.
Okay. Why is that? What would you say is a default or more? Why do they default when there's smaller deals? Um, you can't on a smaller deal. Um, it's harder to run a smaller deal than a big deal. And here's what I'll say: if you have 100 units, when you hit that 100 unit mark, and just as a general rule, when you hit that mark, you can hire a professional manager that's going to sit on the property through business hours every day. You're going to have people that are taking care of the maintenance for you. They're going to be on call. You're going to have probably two guys, one working part time, one working full, and they're going to go on call 24 hours a day, and split that time. You're not receiving those calls, so you're not getting burned out with those things. And you've got professionals doing these things. On the smaller deals, if you've got a 20 unit that you paid $1 million for in Dayton, Ohio, and let's say you live in Dayton or you might live in Pittsburgh, um, it's going to be hard for you to afford to pay someone to take those calls. And generally speaking, what happens is the person that bought the property is going to be taking those calls. if they're a professional and have a job that takes their time, they're gonna have to hire somebody, and every time they get a call, it costs them money, and it doesn't pay for itself. When you get the bigger properties, that those things pay for themselves. So I hope that helps. Economies of scale, I guess you'd say. Um, nice, Dexter, taking on the on the capital raise, and I like it. Good job. All right. So location is important with the deal. They're going to look at the economy of the area. They're going to want to see that there's jobs in the area, that there's more than one company hiring. It might be a military town. Those are kind of a no-no in a lot of cases for the banks. They don't like lending in those areas because if the soldiers at that base get deployed, the wives are generally going to move back, or husbands or whoever it is going to move back home and not keep that apartment out of town, and their tenant base moves out. And that happens in oil towns, a lot of different things. So they want multiple jobs. They want good areas without crime. They're going to do building condition inspections and condition reports, and they're going to look at the tenant base. Who's paying the bill? And that's the tenants. They're going to say, hey, where do these tenants work? What do they do? Is it blue collar? Is it white collar? Are they young professionals? Are they older? They're going to take all these things in consideration when the lenders are when they look at these projects. And then they're going to look at the borrower strength. Borrower strength is experience, net worth. To be able to qualify for a commercial loan, you've got to have a net worth equal to or greater than the loan amount. And then they're also going to look at the SREO of the person. And when we look up here at have a business plan for cash flow in the future, that right there is, if you have a business plan of renovating this apartment complex or 150 units or, whatever it is, your KP, if they've never done a big renovation project, you're going to have to find somebody with that experience. The banks just don't give money out to people that haven't experienced these things. And so to do your first deal on a deal like that, you're going to have somebody partner with you that has done those things. And maybe it's just finding your GC and bringing them in as a little bit of an ownership role there, and doing it that way. So a lot of different ways to skin the cat, they would say. So you can also turn into a passive investor. And as a passive investor, a lot of different things you could lend on. You could find somebody that, wants to do the smaller deals. You could, go 50-50 with them on fix and flips, or you could do, single fan, whatever you want. You could become an LP on a syndication deal. Um, we was at the Horse Park, Kentucky. We're not too far from Lexington, and we were at the Kentucky Horse Park over the summer, and we got to see a racehorse. It was the first racehorse that was syndicated. Somebody bought a racehorse. I think it was what, $25 million for this racehorse, and it was a syndication. A bunch of business guys put their money together and bought a racehorse, and that racehorse ended up making them a ton of money. I forget all the numbers, but it was pretty cool to see that they're even syndicating racehorses. So invest in debt funds. There's a lot of private lenders out there that are lending on deals, and you can invest in the debt portion of the deal. Those are usually really, really stable. Depending on what their interest rates and things are they're charging, you're gonna make a percentage on that, but it's real stable, backed by the real estate. There's crowdfunding you can get involved with. I said invest in other people's smaller deals, invest in real estate backed stocks. We go back to that CMBS. Invest in equity funds. There's people that are raising equity. So what's the difference in an equity fund and a debt fund? An equity fund is, a debt fund is going to lend on that 65% range of the project, and it is backed by the real estate. That's what the bank lends on. That equity portion and that debt part is usually a lower percentage on the interest rate, more stable, but less risky. If you're investing in equity funds, the equity portion of the real estate, if the value goes up, you're going to share in that appreciation of the project. If the value goes down, sometimes the equity gets wiped out and you lose your money. But with equity is where you can double your money in 2, 3, 4, 5 years. The debt funds, rule 72, if you're getting 5, 10, 5, 6, 7%, chances are you're not going to, whatever the rule 72 is showing, I'm not sure what it is with 5 or 6%, but you know, it is just a less risky investment, but more stable. So, um, I believe real estate is the best and safest investment out there. What is the best type of real estate to invest in? Uh, you'll have to weigh that out yourself. I do know that we've invested in several different types, several different areas, and just all these different things, and we've not lost money on any of them. And they've all been. I mean, we've made money on all of them, and it's been good. Um, we bought one last month. We bought another property last month when some people are saying, "Hey, it's not a good time to buy. It's not a good time to buy," but we're going to make 11% on our money that we invested. So, and when is the best time to buy real estate? Uh, I believe the best time would have been 20 years ago. But if you didn't buy 20 years ago, today's the best time. So that's what they say about planting trees. If you want a tree, the best time to plant it would have been 20 years ago. If you didn't plant it 20 years ago, plant it today. Um, so this week's verse, Leviticus 19:13, do not defraud or rob your neighbor. Do not hold back the wages on a hired worker. So pay people what they're worth on all fronts. Okay. So that is the end of this part of the call.